So once again, welcome to the financial management class. Today we'll discuss about financial statement analysis. So in FS analysis, we're going to discuss the comparative financial statements and ratios. No, so FS analysis involves careful selection of data from financial statements in order to assess and evaluate the firm's past performance, its present condition, and future business potentials. No? So the objectives of financial statement analysis are number one, maximize profitability. Check the ability of the firm to pay its obligations, safety of the investment in the business, uh, assess the effectiveness and efficiency of management in utilizing the resources entrusted to them, and attain stability in operations. Okay, so what are the problems and limitations of financial statement analysis? No? So number one, the nature of the information. So the use of estimates in allocating costs to each period. Financial data is not just adjusted for price changes or inflation or deflation because of cost principle. Companies have choice of accounting methods. No? So these differences impact ratios and make it difficult to compare companies using different methods. Companies may have different fiscal year ends, making comparison difficult if the industry is cyclical. So, class, basically, what this is telling us is that while financial statement analysis is really a good way to predict the future, so by looking at the past performance or past data, or our financial statements, um, there are challenges, so like for example, when we're comparing industries, so companies within the same industries, those companies, they can choose different accounting methods, and that's why, um, so long as it is compliant with the generally accepted accounting principle, that's good, no, that's the basic requirement. Now, it's also mentioned here that it might be difficult to compare it with company with different fiscal year. So meaning to say, what if company A runs its business from March to Feb? No, of course we can do that. No, so another company can operate in the calendar year. No, so that's also that's also uh, allowed. No? The need to look beyond ratios. No? So ratios or any information generated by financial statement analysis are not the ultimate goal. The company must interpret and look beyond these results for a more proper evaluation. So class, later on I will provide you with a list of ratios. No, there are a number of ratios that we have to understand. So, while the basic requirement is for us to calculate for those ratios, of course, we have, as financial manager, we should be able to interpret them, no? So as to guide us in our business decisions, no? So now, what are the techniques in financial statement analysis? So number one, we have the horizontal analysis. No? So horizontal, it's a line from left to right. No? So basically like this. No? So it is the process of analyzing the firm's financial data across two or more consecutive periods. This is done through either comparative financial statement or trend analysis. So trend percentages are index numbers showing relative changes in financial data resulting to passage of time. In horizontal analysis, the amount of change and percentage of change should be shown ito. So the percentage change is the amount of change over the base, no? So, and actually the base is the last year. All right. So later on, I'll also demonstrate this to you, no? Uh, so basically the approach is first part will we are dealing with the theoretical part, and then later on we'll discuss it using a by illustration, using a problem, no? So what are the cautions about the base, no? So the base may be last year or earlier period data. It can also be the average industry data or even chief competitors data. The percentage change is not computed if the base is zero or negative. Of course, no, it's a formula error. No? So meaning, if there's no available data, then you can't actually compute for the percentage change. No? Right. Next technique is the vertical analysis. So vertical, it's line from top to bottom. No? So the vertical analysis is a method of financial statement analysis in which each line is listed as a percentage of a base figure within the statement. No? So, vertical analysis, a process of comparing figures in the financial statement of a single period only. So, take note of this class. While previously in horizontal analysis, we're actually comparing two periods. So, for example, we're comparing 2020 financial statements with 2019 financial statements. No, so there are two periods involved. No, two calendar years involved. But in vertical analysis, we're dealing with single period only because we're actually just getting the percentage of each item in the financial statement based on the uh, proper base, no? So later on, I'll also show this to you how this is done. No? Proper application of vertical will generate a common size financial statements. Common size financial statements are financial statements that translate peso amounts to percentage in relation to a chosen base. No? So, what are the base to use? What are the bases to use? No? So, if it's an income statement, of course, the base is the net sales. If it's the balance sheet, the base would be your total assets. So, meaning net sales is equivalent to 100% here. No? Also, total asset is equivalent to 100%. Now, if you're going to do a vertical analysis of your statement of cash flows, the total cash available would be your proper base. And so that means your total cash available is equivalent to 100%. So the next technique, probably this is the, let's say, the more challenging one, financial ratios. No, challenging in such a way that there are number of financial ratios that you need to be familiar with. So you really have to memorize all those financial ratios, especially during exams. No, during examinations, you will be required to compute for financial ratio, but the formula, I mean, isn't given. No, but I mean, it's uh, later on, I'll also be giving you techniques on how to easily memorize these different financial ratios. No, so financial ratios, these are a comparison in fraction, decimal, or proportion of two significant figures taken from the financial statements. In comparing balance sheet items with income statement items in a single ratio, the balance sheet items are being averaged if the beginning and ending balances are available. No? So take note of that, class. No? So later on, we'll also demonstrate this. So ratios have great disparities from one industry to another. So meaning you need to make sure that you're only comparing within the same industry, because otherwise there will be a lot of differences, no, that you can take note on. So for example, you are comparing uh, a say tobacco company, you're comparing with a beverage company, no, so definitely you'll see different differences, no, in terms of ratios, no, because uh tobacco industry is different from beverages, no, so well the only well it's pro- the underlying assumption here is you have to compare companies within the same industries only, no, so in order for these financial ratios to be effective. Conservatism has a bias towards diminishing value of the firm, and historical cost principle may significantly contributed to a distorted financial statement analysis. Now, okay. So summary of commonly used financial ratios. No, so here are the ratios, and then here are the related formula. No, so, activity ratios. These are the ratios that measure the liquidity of specific assets and efficiency in managing assets, no? So, when we say liquidity class, this is the ability of the company to meet its short-term obligations, no? Meaning to say their ability to pay their current liabilities. No? So for example, their accounts payable, payroll payable, or accrued payable. No? So what I'd like to do in this case, instead of just reading through these ratios, later on we'll apply it with a problem, and then we'll also discuss the interpretation of each of this ratio. No? So, but take note, class, whenever the ratio is a turnover ratio, the numerator will always be the related uh, income statement. No? So, for example, AR turnover. No? Notice this. AR turnover, the numerator is the related. What's the related or related account for AR? No, so that's the sales. No, and if it's an AP, of course, the related account in the financial statement is your purchases. No, so like AP turnover, you have net credit purchases. What if it's an inventory? So of course, it's your cost of goods sold. No, so this would be difficult if you don't know the related income statement account, no, for a balance sheet account, no. But I mean, uh, this should be fairly easy to you, no. So, for example, AR, you would know that whenever you're recording an AR, there's sales involved, no. So the numerator would be net credit sales, no. All right. So next we have solvency ratios. So ratios that measure the ability of the firm to pay its long-term financing and extent of a firm's financing. No? So basically, solvency, this is the ability of the company to pay its long-term financial obligations, no, so that's the only difference of this from the liquidity ratios, no. So in liquidity ratios, we're dealing with short term obligations, no. So in this case, we have debt ratio, equity ratio. So debt ratio, so meaning your total liabilities over your total assets. Equity ratio, that's your total equity over total assets. Remember, uh, your total assets here is your base now. So this one, I think the ratios involved here can be easily memorized, no, because it's, I mean, it's straightforward, no? Like debt to equity. So you're comparing debt to equity. So that would be your numerator, no? So right now I'm already giving tips, no, on how for you to easily memorize this equation. No? Another tip would be, uh, every time you're practicing to solve problems in financial management related to financial ratios, no, you have to write down the formula again and again, no? So that by the time that you're taking the examinations or quiz, you would be uh, I mean, you can remember it easily, no? So uh, I remember one of my professors back in college told us that 20% 20% of what we're writing uh, gets retained in our brain, no? So imagine, just simply by writing it over and over again, 20% of what you're writing is retained in your brain, no? So you only need to uh, approach the other 80%, not to okay. So that's just tips naman, no? So you have your leverage ratio or your equity multiplier. So there's the formula. You have your times interest earned. So earnings before interest and taxes over your annual interest and your basic earnings power. So that's your EBIT or your earnings before interest and taxes over your total assets, no? Of course, we also have profitability ratios. So these are the ratios that measure the overall performance of the firm. So when we're looking at the profitability ratios, which financial statement do we look into? Sige nga. Is it the balance sheet, the income statement, the changes in uh, equity, or cash flow? Of course, it's the it's your income statement, no? So you have your gross profit ratio, no? So your return on sales. Ito naman, another tip class, no? If the ratio being asked is return on equity, your numerator would always be the net income, no? So look at this, return on sales. So the numerator is net income over the denominator is net sales, no? Return on equity. So there's the net income. Okay. But in here, return on assets, there's a note here, no? If net income cannot be determined, then you use operating income after tax, no? So meaning it's still the net income. So if it's a no, return ratio, it's then net income would be your numerator. All right. Of course, we also have other ratios here. Earnings per share. Remember, in a corporation, there can be two types of shareholders. One is common shareholder, and the other one is your preferred shareholders. No? So preferred shareholders, they get preference, no, in terms of dividends payment. No? So that's why in earnings per share, basically we're calculating the amount of earnings to be allocated to the ordinary or your common shareholders, no? Dividends per share, so that's the annual dividends divided by the average ordinary shares outstanding. You also have the dividend payout ratio, the dividends per share over the earnings per share. Uh, okay, so you have your book value per share. Market test ratios. So these ratios are concerned with the return on investment for shareholders and with the relationship between return and value of an investment in company shares, no? So you have your price earnings ratio, so market price over your EPS or your earnings per share. Earlier on, we've discussed how to calculate your earnings per share. So that's your net income minus the preferred dividends divided by the average ordinary shares outstanding. All right. Of course, you have your dividend yield ratio as part of the market test ratios. So that's your dividend per share divided by market price. And finally, your earnings yield ratio. That's earnings per share over market price. No? Plus, right now, it won't make really any sense, no, because we're discussing the theoretical part. Later on, like I said, we'll proceed uh, with the problem, no, so to illustrate all of this. No? So don't worry. So just before we go to the discussion exercise, let me give you full overview of what we just discussed, no, what we have already discussed on the financial statements, no. So in analyzing your financial statements, you're basically uh, assisting the statement users in predicting the future. No? So as financial manager, of course, uh, we need to make sure that the data available to us are being analyzed so that managers of the organization can decide, no, on say different undertakings to uh, pursue in the future. So we're looking into the profitability, liquidity, solvency, and stability of the business just by looking through those different techniques of financial statement analysis. Of course, we have already defined what a solvency is and compared it with liquidity. So again, if uh, again, liquidity is the ability of the company to pay its short-term obligation, while solvency, it refers to the ability of the company to meet or to pay its long-term financial obligations. No? So we've discussed the different financial statement techniques, namely horizontal analysis, vertical analysis, and ratio analysis. So remember, in horizontal analysis, we're comparing two different periods. No, it could be, um, but of the same company. No, and then we compare it with the company within the same industry. No? So take note of that, class, in order for this techniques to be effective, you have to compare it only with the companies within the same industry. No? So, say for example, you would like to uh, check how you perform, no, versus your competitors. No? So, like if you're doing financial statement analysis of Shell Corporation, um, you would like to compare it with another oil manufacturing entity. So you can compare it with Chevron. You can compare it with Petron. No? So vertical analysis, it's common size statements. No, so if you're dealing with your income statement, of course, your net income, I mean, your net sales would be your base. No? So, meaning your net sales would be your 100%. And of course, in the ratio analysis, we have went through the different liquidity ratios, solvency ratios, profitability ratios, and the market test ratios. No? So those are the classic examples of ratios in financial statement analysis. Siguro I'll give you another 5-minute break and then so we'll go now to uh, the discussion exercise. No? So don't worry, I'll be all. Actually, I've already shared with you the Excel file for the discussion exercise, no? So uh, at least you can focus on the presentation, no? And then you can just go through the Excel file when you're reviewing for this lesson, no? So for the discussion exercise, the requirement is to prepare a vertical and horizontal analysis for the year 2019, no? So comparative data for Luzon Corporation for the year 2-year periods 2019 and 2018 are as follows. So you have your income statement and balance sheet. No? The additional information for the year 2018 and 2019, Luzon declared dividends amounting to 300,000 and 450,000 respectively. The uh, market price for years 2018 and 2019 are 15 and 18 respectively. Now, um, let's go to the Excel file. Okay, so this is the same. Oops, ano ba ito? This is the same file, no, from the PowerPoint. So at least it will be easier for us to discuss the vertical analysis. So remember, class, in vertical analysis, we're comparing two periods. Sorry. In horizontal analysis, we're comparing two periods. Let's do horizontal analysis first. Let me hide this first. Okay. So, uh, of course, you can have two columns for horizontal analysis. No? So number one would be, first column would be your increase and decrease. And then the second column would be the percentage change. So remember, class, in calculating for your percentage change, it will be last year as your base. No, so in this case, you get the difference first of 2019 and 2018. So that's 2,000 minus 1,500. No, so that's sales. No, class. Um, I just removed the zeros, no? So it's the data is in million, no? So it's 1.5 million and 2 million, as you can see. Just for the sake of discussion, I just remove, no? So for the sake of simplicity, I just remove the three zeros, no? So what is this telling us, no? So in 2019, we have generated 2 million pesos sales, while in 2018, we only generated 1.5 million sales. So there is an increase in sales of 500,000 pesos. Now, uh, in percentage terms, that's equivalent to 33%. No? So meaning our sales in 2019 have increased by 500,000 pesos or 33% increase. No? So that's how we do horizontal analysis. No? So we also do the same for the cost of goods sold, for the gross profit, and then for your selling, general, and other expenses. No? So imagine also here it increased by 50%. No? So again, how to compute that? 150 less 100 in 2018. So that's your uh, total increase, no, of 50,000. So we get the percentage change. So that's equivalent to 50%. All right. So class, that's also what you're going to do for the rest of the accounts or items in your income statement. No? Now we go to the balance sheet. No? So of course you have your cash. The same thing. You're just comparing the result of 2019 or the figures in 2019 versus 2018. No, because in horizontal analysis we're actually just calculating for the percentage change. And remember, class, during your examinations, you don't actually need to complete the whole statement, no, whole horizontal analysis. You just need to uh, check the requirements first. No, that's another tip in that's another tip during the examination. You go first, you read first the uh, requirements. No, what's required? I don't want to be spending so much time in completing the whole horizontal analysis for the whole financial statements, no? And then only to find out that you're only being asked what's the percentage change for your sales, no? So imagine, Tinab, you have already completed the whole horizontal analysis of your income statement, and you have completed your full horizontal analysis here for your balance sheet, and yet the only question relates to the sales, no? So make use of your time, especially during examinations, no? So just read first the requirement before you uh, proceed with calculating the before you go to the procedures required in preparing for your horizontal analysis, no? Like you said, those horizontal analysis class is fairly straightforward, no? In fact, uh, you can do formula like this in your Excel or in your calculator. It's also very easy to follow, no? So if you're using your calculator, you're simply just deduct current year. So 2019 in this case is your current year less your prior year. No, so that's how you calculate for your increase or decrease. Take note, class. Don't be confused. No, what's your current year and your prior year, because it will have an impact in terms of the increase and decrease. So imagine, instead of using your current year as your base, you have used 2018, no? So that's 1,500,000 less 2,000. So it will look like as it will look and appear like a decrease, no? Well, in fact, it actually increased, no? So take note of that. Okay, so, and then also make sure to remember that in calculating for your percentage change, you have to use the prior year or last year to calculate for your percentage change. It will also, if you use current year, or in this case 2019, it will also give you an incorrect answer. No? So I think that's the things to remember in calculating for your horizontal analysis. All right. So, okay. If you have any questions, no, so in horizontal analysis, what I also encourage you to do is before you check on this file, try to solve it yourself. No? So it's this problem is included in the PowerPoint presentation. So you might want to go through it once again and then uh, check or compare your answer with the Excel file that I have provided to you. No, that's the best way to learn this topic. But like I said, horizontal analysis is pretty straightforward. No? With that, let's go to the vertical analysis. No? Again, earlier we've discussed about vertical analysis, and it's comparing single period only. No, so in this example, we have two periods. What is required? We are being required to do horizontal analysis for 2019 only. No, so it's really 2019 only, and yet we've completed year 2018 and 2019, no, for the sake of illustrating it. No? So take note, class. that if you're doing a vertical analysis for your income statement, your net sales will be your baseline. No? So meaning this is equivalent to 100%. And then from there, you can work back. No? So how do we do that? No? So imagine, let's do 2019 first. So let me highlight this in yellow. So this is also in yellow. So if we're doing a vertical analysis of 2019, so your sales is equivalent to 100%, you can simply input 100% or 2 million divided by 2 million. So that's still 100% because the next formula in cost of goods sold will be 1,200,000 divided by your total sales, no? Because your total sales is equivalent to 100%. So this will be your baseline, no, in the income statement. So that's 1,200,000 divided by 200 1,200,000 divided by 2 million. So that's equivalent to 60%. Of course, in your gross profit, you can simply deduct COGS from sales, no? So that's 100% minus 60%. So that's equivalent to 40%. Or what you can do is also calculate for it. So that's 800,000 divided by 200 divided by 2 million. So that will also give you the same percentage, no? And then for your selling, general and other expenses, so that's 8%, no? So that's 150,000 divided by 2 million. So that's 8%. And of course, for the tax, so that's 195 divided by 2 million. So that's 10%. No? Then you can arrive with your net income simply by deducting 8 and 10 from your gross profit. That's one way to calculate for it. Or you can simply you can simply calculate for it. No? So 455,000 divided by 2 million. So that's also, I mean, that's another way to calculate for your net income. Okay, so that's how you calculate for the vertical analysis for your income statement. No, imagine class, what could be the use of this? No, so imagine we're analyzing 2018 and 2019. Uh, in this case, uh, total sales, I mean, total cost of goods sold and your gross profit remain the same in terms of percentage lang, ha? And yet, the selling and general administrative expenses went up by 1%, no, in 2019. So what essentially, as a financial manager, what we'd like to know is what drove this 1% increase in the selling, general and general and other expenses. No, of course, right now we're just seeing percentages, no, but in reality, we need to really dive in, see what are the factors contributing to the increase, no, in this particular line, no? Especially, say for example, no, in 2019, it's good that the cost of goods sold here remains at 60%. And what if this becomes 80% in 2019? Of course, there's really a need for us to determine what triggers an increase in total cost of goods sold, because as you know, increase in cost of goods sold would mean decrease in your bottom line figures, no? So the higher your expenses and your costs are, it will eventually result to a lower net income, and we don't want that, no? As financial managers, we need to be uh, informed about the causes of those increase, especially in our costs and expenses, so that we'll be able to strategize. No, we'll be able to recalibrate our operations to make sure that the uh, in the future we'll be able to manage our resources well. No? So uh, that's how we analyze or how we use vertical analysis. Now let's go to the vertical analysis for your balance sheet. No, class. Like I said, I've already provided here the vertical analysis for 2018. While this is not part of the requirement for illustration purposes, I've also included it here. No, so I encourage you to do is also to calculate it yourself and then compare it with the ones reflected here. No, now in if in case you find any differences in your answer uh, versus in Excel, number one thing for you to do is, of course, look into the formula in the Excel file. Now, if you're still not convinced or say still need further explanation, just feel free to send me a message, and then I'll take time to explain it via chat or via message uh, in Canvas or in any other platforms. No? All right. So moving on to your vertical analysis using your uh, balance sheet. No? So you have your cash, your AR, your inventory, your prepaid expenses, and your property, plant, and equipment. No? Of course, in balance sheet, you have your total assets as your baseline. No? Of course, you can't use your cash as baseline. No? Cash is just part of your total assets. Now, what if um, your manager would like you to assess current assets only? Of course, your current assets would be your baseline. No? So that will account for your that will be your 100%. No? It's really case to case basis, but in this case, we're looking into total assets. No, so what is the contribution of cash to your total assets? So basically, that's what we're looking into vertical analysis now. So imagine your cash. You only have 7% cash of the total assets, no, and the AR of 80% of 20%, no. So let's do it one by one. No? So how do we calculate for this? Again, um, 150 divided by 2,200,000. No? So that's 7%. 450 divided by 2,200,000. So that's 20%. And then your inventory of 400 divided by 2,200,000. That's 18%. Your prepaid expenses of 50 divided by 2,200,000. So that's 2%. And finally, your property, plant, and equipment of 1,150,000 divided by 2,200,000. So that's equivalent to 52%. So meaning, class, out of the total asset, 52% of it is coming from your property, plant, and equipment. Now, total current asset is equivalent to 48%. Again, class, the way you approach problems in financial statement analysis using vertical analysis technique is also to read through the requirement first, no? Because obviously you don't want to spend a lot of time calculating for the vertical analysis of your incomes of your balance sheet, no? While you're only being asked for a portion of it, no? So like for example, you're only being asked of the percentage of AR to total assets. No? So that the answer is 20%. No? You actually don't need to calculate for the inventory, your prepaid expenses. You can go straight to AR. No? So, but for presentation and illustration purposes, I've completed the whole balance sheet for 2019 and 2018, no, to illustrate how vertical analysis works. No? So let's go to your liability and equity. So remember your basic accounting equation class, huh? So that's asset is equals to liability plus equity. So therefore, if you're doing vertical analysis, your total asset is your 100%. But the other equation to your right is the liabilities and equity. So therefore, total liabilities and equity is your baseline. So you can't do 50-50, huh? So like you put 50% to liability and put another the other 50% to equity. So if that happens, no, so for example, if that happens in a given problem, it's just purely coincidence, no? So you have to get the total liability and equity as your baseline. All right. So uh, let's do that, no, for the liabilities and equity portion of your balance sheet. So again, your accounts payable of 200,000 divided by 2.2 million pesos. So that's 9% here. And then your notes payable. Plus, I just abbreviated it. No? Of course, it's right here. No? So you won't also be confused. No? So notes payable. So that's 18%. How did I calculate for 18%? So that's 400,000 divided by 2,200,000 pesos. No? So you have your bonds payable of 23%. So that's 500 divided by 2,200,000. And for your common stock, so that's 400 divided by 2,200,000 or 18%. And finally, for your retained earnings of 700,000 divided by 2,200,000 is equal to 32%. Class, what if the question is what is the percentage of your total current liabilities to total liabilities and equity? So the answer is, of course, these two, 27%. No? Your accounts payable and your short-term notes payable, these are your current liabilities. No? Of course, your bonds payable, earlier on, we've talked about bonds, and these are actually long-term liabilities. No? Of course, your common stock and retained earnings form part of your equity. No? So I hope that's clear. Okay, so that's vertical and horizontal analysis. No? So I'll give you another five. So earlier we've discussed the oops, proceed with ratio analysis, no, for 2019 by computing the following ratios. No? So there are 25 ratios, and then we'll apply it with 2018 and 2019, no, if it's possible. Okay. So number one, um, of course, I've already placed the uh, data, no, from the financial statement here, no. So that's why my numbers are just already linked, no. But then we'll get through the um I mean each of the ratio, no, as we discuss it, as we go through it, no. So let's do it one by one. Current ratio is actually your current asset divided by your current liabilities, no? So that's 1.6 for 2018 and 1.8 for 2019. So I've indicated it here. That's the higher the better, no? Meaning more current assets are available to pay current obligations, no? The simple test here is one, no? It should be one equal or greater than one, no, for your current ratio. So meaning to say, um, for every current liability, you have 1 peso, no, uh, to you have the ability to cover for it, no? So when it becomes due, all right. What is acid test ratio, no? Class, in acid test ratio, actually this is similar with current ratio. The only difference is that you're only accounting for uh, highly liquid assets, no? So pag-usapan natin 'yan. What are your highly liquid assets? No? So these are your current assets that can easily be converted to cash. So of course, you have your cash and your accounts receivable, no? Your inventory kasi class, while this is part of your current assets, no, it has to be sold first, no, before you can convert it to cash, no. So in asset test ratio, it says here that it's the higher the better, and more current assets are available to pay current obligations, no, meaning um, you're assessing your liquid assets, no, meaning your cash or your cash equivalents, or uh, including your accounts receivable, no, because these are highly liquid assets, no? So meaning you can easily convert it to cash and settle your short term liabilities or current liabilities. Next we have AR turnover. Take note, class, when we say turnover, we're actually looking into the uh, related portion in the income statement, which is your net sales, no? So remember, di ba? The sale in basic word, what is the partner of your AR in the income statement, no? It's the net sales, no? And of course, whenever you're being asked to do uh, ratios involving balance sheet accounts, you have to get the average, no? So in AR turnover, that's actually your net sales divided by the average of your beginning and ending AR, no? So in this case, class, what is your beginning AR? Of course, your beginning AR would be the balance from 2018, no? And then 2019 is your ending balance, no? So you have to get the average of that to compute for your AR turnover. Okay, so what is this ratio telling us? This is the number of times receivable is reinvested, no? So imagine uh, you have your cash cycle, no? So whenever you sold inventory, so that becomes your receivable, no? So when you sell your inventory, it will you will recognize your receivable, and then when you collect from your customer, that receivable turns into cash, no? So that's your basically your cash cycle, no? So it mentioned here that this is the number of times that your receivable is reinvested, no? So again, the higher the better. Uh, the higher the better, meaning you're comparing it with another company within the. Let me just check if if it's being recorded, okay? And okay, sure. Okay. Remember, class, in financial ratio analysis, in order for this to be beneficial, in order for this to be beneficial, you have to compare it with companies within the same industry, no? So, for example, this is Luzon Corporation. Uh, um, let's say Luzon Corporation is engaged with uh, uh, telecommunication na lang, no? So, say for example, it's the third player, no? So, Luzon Corporation is the third player. So, meaning you have to compare your financial ratios with another competitor. It could be Globe, it could be PLTT or Smart, no? So, when you're comparing your AR turnover, this must be higher than the competitor. So, meaning uh, this is basically uh, gauging the number of times your receivable is reinvested, no? Next, we have the inventory turnover. Okay, so for the inventory turnover, so what's the partner of inventory? It's actually your what? Cost of goods sold, no? So to calculate for uh, your inventory, so you have 1,200,000 for your COGS, and of course, you have to get the average again of your inventory. So beginning inventory of 300 plus ending inventory of 400 divided by 2. That's how to get your average, no? So so that's 3.4. Again, the higher the better. It is the number of times inventory is reinvested, no? So for inventory turnover class, remember, uh, I mean, for all this ratio analysis, you have to compare it with another company within the industry, no? So you will compare it. Say for example, in our illustration earlier, this is related to telecommunication companies, no? So we would like to have higher inventory turnover compared with the other players within our industry, no? Now, the days AR at the class now. In days AR, generally, if the problem is silent, you have to use 365 days. Now, if of course, if the problem tells you to use 360 days, by all means, follow the problem. So don't ever compete with the problem. Ah, no, it's 365 days according to the calendar. No? So don't do that. No. So in this case, the problem was silent, very silent. In fact, I'm the only one talking. No? I'm not sure uh, why there's no students in the class right now, but we'll deal with that later. No? So uh, it's 365 divided by your AR turnover, no? So days AR. So meaning it's the number of days your AR is outstanding, no? So of course, the shorter the better, no? Because we're talking about accounts receivable. And of course, while credit is good, while credit is good, we need cash, no? So imagine uh, your AR staying uncollected for 77 days, no? So will you be happy that your not gen or your receivable uh, takes so longer to be collected, no? So in fact more than 2 months, no? So again, the gauge here is to compare it with the other industry players, no? How long do they collect their accounts receivable, no? So from there, you will need to strategize, no? So for example, Luzon Corporation takes 77.56 days uh, before they collect their AR, and yet Globe takes only 30 days. We have to reassess, no? So probably there's issue in our credit management, no? Why do we allow customers to extend their credit line for more than 2 months, no? Is it with the intention of getting more customers? Probably yes, because in our example, Luzon Corporation is the third player in the telecommunication industry. But remember, while it's good to increase your customer base, at the end of the day, we need to make sure that we collect these accounts receivable from them. No? Otherwise, it will impact your liquidity, no? And you don't want that. No? Okay, so days inventory. Next, days inventory. Actually, this is just uh, 365 divided by your inventory turnover. Again, class, the shorter the better. It is the number of days inventory is held as stock. So meaning, this is the number of days your inventory stays in your balance sheet. No? So again, you don't want to hold your inventory long, um, especially if it's longer than your competitors. No, meaning there's problem in the sales of your inventory. So it could be also a problem on inventory management where you're holding a number of inventories compared with the number of being sold. No, so remember, higher inventory also leads to additional cost like holding or carrying costs. Of course, you need space, no, for those inventory. So you need to if you don't have facility, you need to rent for a warehouse. And again, we don't want additional cost out of just handling your inventory, no? So that's why there's also another topic in financial management called inventory management. And then I think that's also part of your succeeding topics, no, for financial management. So we'll touch more of that in the next coming weeks. All right. Next, we have AP turnover. AP turnover is simply your purchases. No? So in this case, purchases is not available, but we can recalculate or we can calculate for that given your beginning inventory, your ending inventory, and your cost of goods sold. So your purchases is equivalent to uh, 1.3 million divided by your average AP. So that's beginning AP of 150 plus ending AP of 200. No? So divided by 2 to get the average. No? So again, the accounts payable turnover ratio is a short-term liquidity measure used to quantify the rate. No? So for AP turnover, this is the uh, uh, how fast you settle your accounts payable. No? Next, we have days AP. So again, 365 divided by your uh, AP turnover of 7.43. So this is the days payable outstanding or your DPO. It computes the average number of days a company needs to pay. So, in this AP class, imagine this is your short-term obligation, no? So your accounts payable. Of course, in the point of view of the company, you would like this to be extended, no? As long as you can, no? But again, um, so long as you're able to meet it when it becomes due, there's no problem, no? So what I'm trying to say is it's okay to have debts, but make sure that you have the ability to settle them when it becomes due. No? So otherwise, it will also impact your liquidity. It will also impact your credit standing. No? So companies do not want to extend credit lines to companies who cannot demonstrate ability to pay short term, no, even long term, no. So especially when we're already talking of long term liabilities, meaning you're expanding, and that's why um, you're gearing towards getting long-term financing, no? So that's again, that's part of another session on capital budgeting, also part of financial management course, no? Next, we have total asset turnover. So in total asset turnover, it's your total sales divided by your total assets. No? It determines the number of times investment in assets are reinvested in sales. No? So again, the higher, the better. Next, we have the fixed asset turnover. Oh, take note, class. Huh? So when we're being asked to compute for turnover, your numerator will always be your net sales. No? If it's turnover. No? So take note of that. No? That's a way to easily memorize this kind of formula. No? So in this case, fixed asset turnover. So we go to your fixed asset. No? So in this case, your property, plant and equipment. So that's 1,150,000 divided by 2 million. So that's equivalent to 1.7. So it determines the number of times investment in fixed assets are reinvested in sales. No? So again, the higher the better. Now let's take a look at your debt ratio. Class, we're now looking into your solvency ratios. No? So your debt ratio, so it's actually your total debt divided by total assets. No? So in this case, your total debts, o class, take note that it's debt ratio. So meaning it's your total debt. So that's your current liabilities plus non-current liabilities, no, divided by your total assets. So basically, this is just the ratio of total liabilities to your total assets. It measures the extent that portion of total assets provided by the creditors, no? So meaning to say, out of your total assets, 50% of that equates to those provided by your creditors. No? So meaning, these are from various credit sources. No? Then what about your equity ratio? So in this case, class, uh, as you can see, it's 50% for debt ratio and equity ratio because these are complementary ratios. No? So meaning, if your debt ratio is 30, say for example, if your debt ratio is 30%, it's automatic that your equity ratio is 70%. No? These are complementary ratios. No? So how do we compute that? It's actually your total equity divided by your total assets. Again, um, this is only showing us the amount or the level of your equity, uh, the amount of assets that are financed by owners investment, no, or equity. Okay, next is your debt to equity ratio. So actually, class, debt to equity is simply your total debts divided by your total equity. So it measures the resources provided by the owners of the business. No? As you can see, class, I've intentionally not calculated for times interest here. No? So this is for your assignment. No? Okay. So I've already provided you the formula for times interest earned. Just try to calculate it yourself and then we'll discuss next meeting. Let's go now to basic earning power. Basic earning power, it's your net income plus your tax. So how do you call that class? It's your income before tax, no? Divided by the total assets, no? So that's basic earn. It indicates the ability of the firm's assets to generate operating income. So um, remember your total your assets. These are your resources, no? So resources in order for you to generate operating income. Next, we have gross profit ratio. Ito class, we can't skip this because we've already calculated the gross profit ratio here. No? So it's 40% and 20% for 2019. Ba't ganun? Ano ba 'to? Tama, 40%. So, would be 1,200,000 divided by 2. Yeah, there you go. Right. So next we have your return on sales. So again, if it's a return, what did I tell you earlier, class? You have to use your net income as numerator. No, it's return on sales. So that's net income divided by your sales. So 455 divided by 2 million. So that's equivalent to 0.23. Now it is used to evaluate companies' operational efficiency. Next, we have return on assets. Now, class. Again, uh, right now we are dealing with balance sheet accounts again, so we have to get the average. No, so in this case, your total assets beginning and your total assets ending divided by two, and then you have the numerator of your there's a numerator your net income. So that's 455 divided by the average of these two. No? So that's 22%. No? Again, 22%, this is an indicator of how profitable a company is relative to its total assets. Okay, next we have return on equity. So again, return on equity. So I'm sure you already have in your mind, no? So if it's return, you're actually getting net income as your numerator, no? Tama ba 'yun? 'Yun yung napag-usapan natin earlier, 'di ba? So there's your numerator, no? So your net income divided by the total equity. So average, no? So get the average of these two. Uh, Again, I think that the confusion here would be to for you to be able to identify these accounts, no? So your common shares or your common stock and retained earnings, again, this form part of your equity. So therefore, you have to get the total values for this and get the average, no, to calculate for your return on equity. It's 43%. No? It measures the rate of return that the owners of common stock of the company receive on their shares. No? EPS, the earnings per share. No? So we have your net income. Where did I get the 40? No? So in this where did I get the 40? So let's go back to um, our formula for EPS, no, for illustration purposes, no, where EPS. So for earnings per share, it's actually the net income minus the preferred dividend divided by the average ordinary shares outstanding. Okay, that's take note of that. Probably I can just get it and then Place it here. Now, how are we going to get the ordinary shares outstanding? So here, class, the total common stock is 400,000. And how many shares? Uh, what we need to do is compute how many shares are included in here. No, so it's 400,000 divided by the par value of 10. So we have 40,000. Uh, EPS here. So here we have the net income of 455 divided by 40, or 455,000 divided by 40,000. In this case, I just remove the 3. No? So at least, okay. So that's 11.38. This is the earnings per share. So meaning, in this case, class, we don't have a preferred stock. No? So we only have common stock. So meaning, what an EPS is telling us, this is the amount of the amount in peso that each share can get, no, out of our net income. Okay, next we have the dividend per share. Dividend per share. So how much is the dividends? No, it's given. In 2019, Luzon paid dividend of 450,000 divided by, of course, the number of shares. So meaning, per share, this is the amount of dividend paid, no? So 11.25. Of course, the point of view of the uh, shareholder, you would like to have higher dividend, no? So again, you have to compare it with the other players in the industry. Next, we have the dividend payout. The dividend payout is simply your dividend per share divided by your EPS, and that's 0.99, meaning this is the percentage of earnings paid to shareholders in terms of dividends. And finally, or we're down to our final two. No? Final two is dividend yield ratio. And remember your dividend yield ratio is calculated by dividing your dividends per share over your market price of 18. No? Ayan. It's also given in the problem. No? So this is the percentage of company share price that it pay out in dividends each year. And finally, the last one, it's your earnings yield ratio. It's your EPS. We have calculated EPS earlier, divided by the market price. No? So that's your earnings yield ratio. So again, class, the ratio analysis may seem to be really challenging because there are a number of it, but uh, like I said earlier, if you try to write it down and practice computing for it, it will become easy, no, to solve for this type of problems, no, especially for liquidity ratios. These are fairly straightforward, no. If back in my time, I would only memorize for this portion, no, because these are somewhat not um, not explicitly uh, provided, no? Like for example, if we're going to calculate for the return on asset, it's given, no, within the description itself. So return on asset, I know that the return uh, uh, is simply telling me to use net income. Of course, there's the asset, no? Return on equity, it's net income over equity, no? So just take note of those tips, no, on how you can easily memorize or how you can easily remember, no, remember these types of ratio. So that ends our discussion on financial statement analysis. No? So